Welcome to Wealth Made Simple with Shaz, where you'll learn how to master your money through business, property, and tax-saving strategies. Your host has collectively helped his clients make tens of millions of pounds in additional profits through these strategic approaches to business. Introducing Shaz Nawaz, an award-winning chartered accountant, property tax expert, entrepreneur, and property investor.
Week on Wealth Made Simple, I am talking about how to create a second or additional income and the importance of it. And then I'll also share with you how you can buy a business to create that second or additional income without spending any of your own money. So to start off with, let's talk about why a second or additional income is important. And I'll start off talking about why one income alone is a dangerous place to be, even though most people are there. So let's talk about having a business. So let's say you've started a business or you have an existing business, whatever the business is, it doesn't matter. Relying on that one source of income is always dangerous because that business could go wrong. In fact, I've said for many, many years, the number one in business is the most dangerous number. So being over reliant on one employee, on one income stream, on one client, customer, patient, tenant, and relying on one particular product or service that you're selling is dangerous because, and I use the word dangerous on purpose, because if that were to go wrong, then you're in big trouble. So let's say you rely on one key employee. But if that employee falls ill or sick, decides to leave, or something else happens, how is your business going to function? Well, the answer is with huge difficulty. That's why we all need to make sure that we diversify the risk so it's spread over a number of people or entities or sources. The same applies to when I talk to some business owners who have one significant sized client or customer, and let's say they contribute 25% of their income. And when the going's good, by the way, the going's really good, but I've seen this a few times in business now, where that relationship ends. And then what happens is losing that huge chunk of income has a massive strain on a business. So somebody's, let's say, just bought a new warehouse or a new offices or new premises. They've employed more people. They've set up the resource, the infrastructure, because they've got this large client who's bringing in a significant amount of revenue. Well, when you lose them, and if you lose them, and you will lose them because clients and patients and customers come and go, that's just how business is. When that happens, all that extra resource and infrastructure that you've created is going to cause you massive cash flow problems in the short term, because now you've taken on the extra employees, you've got bigger premises which you need to obviously keep going, and if the additional income isn't coming in and you've had a huge hit on the top line and obviously the bottom line, then you won't have the cash flow to be able to keep that going. You won't be able to sustain it. So that's going to cause you huge problems. The other side of that, of course, is when you have one big client or customer or patient, then your independence is at risk, because you're more likely to do things for that one entity than you would be for any other customer, client or patient. So you're going to go out of your way to try and keep them happy. You might push the boundaries sometimes, depending on the type of business you're in, to do more for them. So you kind of become beholden to them without sometimes realizing. And that isn't a good place to be, because owning your own business, and part of the reason why you own your own business, is to have a certain amount of freedom. That doesn't always happen in reality, by the way, but that is one of the key factors. Most people like to be self-employed. And the kind of stunning joke most people make once they've been in business for a while is the only reason that they work for themselves is because nobody else would employ them. And they're absolutely right, because they've picked up certain habits in terms of their working hours, how they run the business, how they do things. For them to now change that, to be told by somebody else what to do, is a difficult transition. And most people will obviously not want to do it. And that's why the number one or in business is a big problem. And like I've said, I've seen it go horribly wrong a few times, and that's then cost businesses a lot of stress, time, money, and sleepless nights over many, many months, sometimes years. Because let's say you're turning over £1 million and you have one particular client who gives you £250,000, 25% of your income. And by the way, it doesn't have to be 25%, could be 10, 15%, could be more than 25%. But if it's a significant number and you lose that particular client, and using my earlier example, you've just taken off £250,000 from your top line. And let's say on £1 million, if you're making £250,000, let's call it £200,000 profit, so 20% net margin, losing that £250,000 of turnover, depending on whatever your gross profit margin is, and let's say the gross profit margin is 60%, that's 150 grand. You've knocked off 150,000 pounds from your bottom line. So you're making 200 grand profit with the client, that particular client. You're making 50,000 pounds without that client. A huge, huge difference, which isn't worth the risk. So as kind of appealing as it may be, when you take on a really big client, bigger than any of your other clients, to take them on, you need to be sure that that works for you. So once you've taken on the first one, by the way, you might want to target other bigger clients. So there's no one particular client who is significantly bigger than all the others. That's one way to do it. Or the second way, maybe just to decline and say, we deal with clients, and using the example of the £1 million turnover, let's say the average fee is £10,000 per client. So £10,000, £15,000, £20,000 income you might be comfortable with. Going over that figure, you might say, this is getting a bit too much for us. So look at your average fee base and then base it on that. Don't just look at the shiny pound notes and think, I'll take this client on and I can manage them. And by the way, when you have a client which is bigger than your other clients, their needs tend to be different. So if you're dealing with smaller size clients, you're probably not cut out to be looking after them and servicing them, because you don't have that size of client in your client base already. So I would urge you to move with caution on that. Now let's move on to having a second and additional source of income and why that's important. See, most people are employed or who are self-employed, and of course, Wealth Made Simple is not just focusing on people who are self-employed. We focus on people who are employed as well. Anybody out there in the community who is looking to create wealth. And wealth, like I've said and Kieran said in the past, has different meanings to different people. And it's not just about money, although money obviously helps you to achieve some of the things that you want to do to make a bigger difference. And if you've got, and I'll just use business as an example, if you have a business turning over a certain amount of money and making a certain amount of profit, then what happens is we all end up changing our lifestyle based on how much money we're making. So all too often I've had a business owner, let's say, making £50,000 profit and saying, if I get to £150,000, my life will be really easy to some extent and better. And then lo and behold, we set up a plan in terms of how they can get to that figure, and they do, by the way. And when they're at 150, guess what? The money left over at the end of the month is exactly the same, if not less, than what it was when they were on £50,000. Why? Because they end up buying a bigger house, they end up buying a bigger car, going on bigger, better, more holidays, spending more money on clothes, fashion, watches, so on, so forth, whatever their interest may be, sending their children to private school if that's something that they want. So we add extra things in our life to use up the additional income that we're generating. And that's why you're always playing catch up. Now, of course, there's a figure that you get to, which you might not exceed. So once you're earning, let's say, £300,000 plus, your expenditure usually won't increase in line with the additional income that you're creating, because that £300,000 is sufficient for most people to meet the extra needs that you may have in terms of having something bigger, i.e., the car, the house, so on and so forth, the holidays, as I've said earlier. But until you get there, your cost will increase. So just thinking if you have an extra 10%, 15%, 20%, 100% additional income using the £50,000 example I've shared isn't going to solve any of the issues that you think it's going to. It's going to help. It's just that you're going to create a better lifestyle for yourself and you'll use that money up. I've seen a very small number, by the way, and I mean a very small number of people who once they increase their income, and by income I mean the income that goes into their personal bank account and not the profits of the business, but once they do that, are disciplined enough to stay in the same house, have the same car, have the same lifestyle, and spend their disposable income in the same way that they were spending it when they were on a much lower income. Most people can't resist the temptation to have bigger and better, whatever that may mean. So increasing the income in one business doesn't always help people create more wealth, because most people spend it and aren't disciplined to say, I've got this extra income coming in, I'm going to save it and I'm going to invest it. And we've covered investing and saving on other episodes in the past, and of course we'll continue to do that in future episodes. So what's the answer? The answer, I believe to some extent, is to create additional sources of income. So now you've got the £50,000 business I've talked about, you've improved it and it's gone to £150,000, and then you should be thinking about, okay, how do I create a second and additional source of income, whether that could be some form of investment income, i.e. Buying property or other assets which will generate you income, or buying a business, an additional business which generates you further income. Because once you do that, and let's say the investment that you make gets you a second business, and the second business is generating £75,000 profit, now you've got 150 from your first business, 75 from your second business, you've got £225,000 which is coming into your pocket, and you can see now it's starting to make a bigger difference. And through that you can then obviously leverage the profits you're making, and you can scale up your business. Now sometimes people will ask, do I continue expanding in the same business that I have, or shall I open a different type of business? So let's say your first business is that you're a dentist, and the second business is you might want to open a care home. So people say, should I go into the care home business, or shall I scale up my dental business? That's totally up to you, by the way. You decide what you're comfortable with. There's a huge benefit in scaling up in the same sector because it's known to you. You have the experience, the knowledge, the expertise, the know-how. You've lived the pain. You've seen how that business works. You dream, breathe, sleep, eat that type of business. You know how it works. So if you're comfortable doing that and having a second office or base in a different city or area, that works fine too. Or if you're saying, I'm in this business, I've seen it, I don't really like it as much as I used to, I think diversifying and having a different type of business will keep me energized, keep me entertained, keep me engaged, keep me enthusiastic, then you can do that. That's totally up to you. And a bit later on, I may cover the benefits of scaling up a particular business and how that can benefit you in terms of having a large exit. Because a lot of people think of their business in the sense that when they come to retire, either their children, if they have any, will take over the business, and other times they think, I will look to sell. The bad news is most small business owners don't end up selling their business because it's not worth much, and that's because the profit it's making, once you take out the owner's salary, which nobody ever does, by the way, usually, because they either tend to be on a very small salary if they're running a limited company, and historically that's been the case, and the rest is taken as dividends, or if they are obviously a sole trader partnership or a limited liability partnership, they're just taking out drawings. Their net profit isn't after their salary cost per se, other than obviously the limited company where they have a very low salary. So once you make the owner's salary adjustment, then for the really small businesses, there isn't that much profit left over. Therefore, the business isn't worth much, and they can't sell it. So the capital value is a challenge. And if you're looking to build capital value, then you've got to build it above and beyond what a commercial salary would be for all the owners who are involved. And that usually comes as a surprise to most people because they don't see it that way. So let's say somebody's making £60,000 profit, and they're running a limited company, taking a £12,000 salary, and that's been taken off before the £60,000 profit. And when somebody comes to buy your business, they say, well, hold on a moment. Okay, someone like you is pivotal to this particular business because without you, the business can't run. And if I were to employ you, would you work for me for £12,000 a year, which is what you're taking right now, and carry on working for me? And the answer obviously is no. So you say, okay, how much would it cost me to replace you in this particular business above and beyond the £12,000 that you're already taking from the business as a salary? And the answer might be, well, another 40,000, maybe 50,000. And once you take 40 or 50,000 away from the £60,000, there isn't that much profit left. Therefore, the business isn't worth much, if anything at all. The other flip side to that is because the business relies so much on you and is person or people dependent as opposed to being systems and processes dependent, then the business doesn't have any value anyway, really, because the minute you depart and leave, the business can't function. So the two things you ought to think about is A, how do you make it systems dependent? And the second one is how do you make it profitable above and beyond what a commercial salary would be for you running that particular business. And that's why those small businesses don't sell. And you need to change that in your business if you're looking to sell it. Now let's move on to the additional and second source of income, or second or additional source of income, because I think that's incredibly important. And I think the more sources of income you can create, the better it is. I am a believer in that. Once you've got 3 or more sources of income, then one of those could be what's known as passive income. There's never anything really that's passive. Things always take up time, and take up more time than you and I would assume, expect, and anticipate them to take, but they do. But generally speaking, what people call passive income is buying property, renting it out, and that's seen as passive income. It really isn't passive per se, but let's just run with that example and call it passive. So you want 2 forms of income, which are some form of trading, buying, selling, etc., some type of service. And the third one then could be passive, so or as passive as it can be, semi-passive, so it doesn't take up too much of your time, because otherwise you only got so much bandwidth and there's only so many plates you can have spinning and so many things you can focus on. Now, of course, once you can scale up to a certain size, you can then afford to employ and take on people who can assist you with managing a business, but they don't come cheap, and the business has to have the economics there in order to be able to do that. And with the economics, then I strongly suggest, without deviating too much, and Kieran's not here, otherwise you'd have taken me down at least 2 rabbit holes by now. What I suggest is you look at your pricing, look at your margins, and then think about how can we price differently, how can we increase the margins. If it's offering some kind of a standard service or product, how can we offer something which is more premium, which is better, so you can cater for a different type of clientele within what you already have. Because just having one kind of price available to the masses means you're missing out on some who want something extra. A bit like gold, silver and bronze. If you're just selling at the bronze level, some people want to buy the silver package. Well, what do you have for silver? And some people may want to buy the gold package. What do you have for gold? And silver and gold usually have a bigger margin because you're offering more in terms of whatever you're selling, and that helps you create a bigger margin. Of course, when you're selling more to the same customers or clients or patients, then the cost of selling the additional items or services is not as much, because you're not spending that much money on marketing, and the customers and clients and patients know who you are. So the upselling or the cross-selling, depending on which way you're going, is not going to be that difficult, because you already know, like, and trust each other. So it's an easier sell where you're sharing with your let's just call it customer for now, sharing with your customer how the additional things or that you're putting forward to them, by things I mean services or products that you're putting forward to them, are going to be of benefit to them, and how you're going to add extra value in that particular process. So I think that's incredibly important, because most small businesses, the economics are very, very tight, the margins are tight. So when there's a change in the economic climate, change in behaviors, attitudes, or there's competition that comes into the marketplace in their particular area, they suffer significantly, because they don't have the margin there to be able to withhold and withstand whatever's coming at them, be it the economic climate, inflation, or something else which is affecting them. And unfortunately for small businesses, when inflation kicks in, what they see is their costs are going up, but they aren't as quick to increase their prices to reflect the additional increase in expenditure that has taken place. So that depletes their profit margin even further. So those are some of the things that I think you ought to think about when running your business, and when you only have one source of income. Then what happens is people have this aspiration or idea of, I could have a second business. And how do I go about it? Well, I want to buy a business, and generally speaking, and this is a very general observation, by the way, let's say you're buying businesses which are 3 times EBITDA. So EBITDA stands for earnings before interest, tax, depreciation, and amortization. And you're looking to buy a business that's making £50,000 EBITDA, or generating £50,000 EBITDA, and you're being told there's £150,000 that you need to pay to buy that particular business. So you could go to your bank, for example, and say, could you loan me some money? Or you can do it through joint venture partners, or you could have the cash saved up in your bank account. It doesn't matter where you get the money from. That's not the purpose of any of our episodes in terms of where do you get the money from. Where we focus more on the ideas and the strategies and the principles. But today I am going to deviate slightly by showing you that the money doesn't have to come from you. But you need 150 grand, and let's just say you use a conventional route, which is by going to a bank. Again, that's not something I endorse, but I'm just sharing it as an example. And your bank says to you, yeah, you could buy it for £150,000. We'll support that. What security is available to us? Because they want some form of security. And then secondly, it's you put in a third and we'll put in 2/3. You cough up basically £50,000 and we'll give you £100,000. And if you don't have that £50,000 saved up, because all the profit that's coming in, you're after tax, you're using for yourself, you've not saved up, you're going to have a big challenge in trying to come up with the £50,000 to buy that particular business. And then on top of that, of course, you're taking a risk in the sense now you're thinking, I'm buying this business, generate £50,000. If it's not in line with my core business, i.e. the business you're already running, what if it doesn't work? I lose my £50,000. I'm giving some form of collateral to the bank, and on top of that, there could be some asset that you've given them charge over. On top of that, the bank may want, and usually does want, a personal guarantee. I've given a personal guarantee as well. And if this thing doesn't work, well, I can't make it work, because remember, what we're good at is looking at all of the negative reasons and all of the downsides. And some people are really good, by the way. They only ever look at the upside and don't consider the downside. Those are the ones who get stung the most, by the way, because they get carried away with these wonderful ideas. But let's just say you're focusing more on the downsides and less on the upside. I think, well, if this doesn't work, what am I going to do? I will have lost my 50 grand because I probably can't sell the business because I've really messed it up. I'll still owe the bank 100 grand less, whatever I've paid back in terms of repayments. I'll be further in debt. My existing business just about supports my own lifestyle and my personal expenditure. So if this thing really doesn't work out, I'm going to be in big, deep trouble. And I've got somebody, by the way, who's in that situation right now, who's talking to me, and we were trying to work our way around helping them out, where they're about to sell their own house to pay off the loans that they took from a bank because they had a particular business that they weren't able to make it work. And that's a very, very kind of sad place to be, because they put their heart and soul into this particular business and weren't able to make it work. And one of the things they said to me is, I wish I'd met you or knew about you 2 years ago, because you could have at least helped create a plan to get us around this. So those kind of things can happen in a business, and it's sad when that does happen. But when that thought comes into your mind, you'll obviously become more hesitant. So in this part of Wealth Made Simple, I am going to focus on how to buy a business without using any of your own money. And in the first part, I gave you an example of a business which makes £50,000 profit, and or EBITDA, because that's what the correct terminology is. And you're buying it for 3 times EBITDA, so you're buying it for £150,000. Okay, what can you do to buy that business without using any of your own money? And then I'll talk about, if you can scale up that operation, some of the benefits which are going to be huge and significant. So one of the best ways to look at it is think about how you can come to an agreement with the seller where you can make a deferred payment. So how this generally works is, you've got somebody who's been running their business, let's say for the last 20 years. They come to a stage where they're thinking, I want to retire now, or something happens in their life which just changes their view of life, and how it's more important for them to spend time with their loved ones, or maybe emigrate because they want to go to a different country, or just take time out. They're looking to sell their business. It's a small business, using the example I've used of £50,000 per annum in terms of EBITDA, and they want out, and they put their business up for sale, and they soon start realizing that people aren't interested in buying their business, or at least aren't interested in paying them the 150 grand that they want. So you come in and say to the seller, I see you've got this business, it's quite decent, it makes a small but tidy amount of profit. There's obviously some potential in this particular business. You've had it for 20 years, so the concept works. Let's come to an arrangement where I buy your business from you, you get some money up front, and then I can pay you some over the next, say, 2, 3, 4, 5 years. And the longer that can be, by the way, the better it is. Now, no one's going to agree usually. I say no one. Most people aren't going to agree to a 10-year payout. I have seen it a few times. That's why I said most won't. But in more cases than not, 10 years will be too long. But 3, 4, 5 I've seen quite often and regularly. And let's just say you did it over 3 years, and you said, I'll give you £50,000, okay, on the 1st, 2nd, and 3rd anniversary, and I'll give you £100,000 up front on completion. And if the person agrees, because they are keen enough to sell their business, the most important word in all of this is keen. And what keen really means is they're motivated to sell. They've got a reason to sell, and you've usually got to find what that reason is. And not every seller will genuinely give you the reason. They'll skirt around and give you some of the reason because they think they've got to make up a reason which is plausible. And I think giving the real reason usually helps the seller, because that tells them where you are in terms of your mindset. But let's just say you've agreed, or they've agreed. So now you can go to your bank or other funder or JV partner or whoever and stamp up the 100 grand. And if you tell the bank you want 100 grand from them, using the example I shared earlier, that's their 2/3 contribution, 1/3 is your contribution. Okay, now you have a deal. So the 100 grand comes from the bank, and the other 50 grand that you've got to pay over 3 years, which is 16,666 odd pounds every single year for 3 years. But that £16,000 you can pay from the profit you're making, because if he's making £50,000 profit, and there's potential, like I said earlier, to improve those profits. But even if you're paying £60,000 from the profit and you're generating 16,666, let's call it 17 grand to keep it easy, 17,000, there's still £33,000 left for you in that particular business by way of margin. So it still works. So you're paying them some from the profits you're making in the future, but you're doing the work, of course, so they're not getting that money for free. they've obviously started the business, and you're not getting the 33 grand for free, you're working for it, and you've obviously put up the 100 grand up front, which either is a loan or some other form of injection or investment into your business, and then they get paid out. That helps you to get to a place where you haven't used any of your own money. If you're really smart about it, by the way, what you're going to do is improve and increase the £50,000 to, let's just say, £70,000. Okay, and from that 70, you're still paying the 17,000, which I rounded up to the nearest thousand in the example. So you're still taking the £50,000 or more profit per year, and you can service the debt and the loan if you have debt and a loan, and you can pay them their share, and you still have a profit remaining. Now, what usually happens in the real world, by the way, is something slightly different. That is the £50,000 that you've got or you're generating. Most people, unless they're really good at their business, end up messing things up. So the 50 grand, by the way, may end up becoming, say, 40 grand or 30 grand. Now, we don't want you to be in that particular place. That's very, very important. So you've got to make sure you find all the ways not to mess the business up. Okay? And what I usually say to people is, if it's making £50,000 profit, I would take off 20% to say you're going to make mistakes. So unless you can, using the earlier example I shared with you, is if you're running a dental practice and you buy a second dental business, then you're less likely to need that particular margin. Although you might still, because there are 54 different factors, by the way, why two businesses in the same sector may be operating differently, from the client base to where they're physically based, to the type of employees that business has, so on and so forth, how their pricing is, where they source their goods from, so on and so forth. But let's just say, all things equal, you understand the business inside out. In that case, you won't need to have such a buffer. But all those who are going into a new business, I'd say have a 20% buffer at least, because you're going to make mistakes. You're going to get things wrong. So £50,000, by the way, is £40,000 in your mind. Now base the EBITDA at £40,000, make an offer of 120, 3 times EBITDA as opposed to 150. And then, of course, you can say to the seller, I'll give you 70 grand up front, and the 50 grand I'm going to pay you over 3 years. So you're taking less of a burden up front. And that's something that you ought to think about as well. And then if the profit were to fall by 20% to £40,000, at least you've still got it part of your calculations, and you won't be too disappointed. But I don't want you to be there, by the way. I want you to make £50,000 into 60, into 70, so on and so forth. But before we look at that, if you have time, by the way, let's look at what happens in the particular process. So once you've agreed to buy the business, you'll create some kind of a proposal or letter or document to say that you are buying the business, and then you generate heads of terms. From that point onwards, you now need to do a few things. The first one is lock in the seller into some period of exclusivity. Say in the next 3 months or 4 months or 5 or 6, the longer the better for you, but it's got to be reasonable, and the word reasonable is a subjective word. What's reasonable to one person is very unreasonable to somebody else. But let's just stick with the word reasonable for now, because that's the word that's used more often than not by solicitors and lawyers. So let's say you agree a 4-month period. Make sure you lock them in, say you cannot sell this business or talk about selling this business to somebody else in those 4 months, because you're locked in. Because the last thing you want is to do all the work and the effort and the cost after 3 months, for example, they say, I found somebody else who's offering to pay me more money. So you are going to be gazumped. And that's not a nice place to be. So lock them into the exclusivity. Then what you need to do is start the due diligence. And keep it very basic. You're going to have 2 forms of due diligence, if nothing else. One is financial, where you pay an accountant to look at all the numbers to make sure that the 50 grand is the 50 grand that's been stated. Because lo and behold, what do people do is they overstate the profit, okay? And your job is to go through those numbers through an accountant and get to the real EBITDA. And the second is the legal due diligence, okay, which make sure everything adds up legally. There could be property involved, okay, there could be a limited company involved. You might be doing a share purchase agreement where you're buying the shares in a company. You might be doing an asset purchase where you're buying the assets. Then you have a legally binding agreement where you've got warranties and you've got other things that go in there, which need to be negotiated and agreed. It can be quite complex, and it is quite complex. More complex if you're buying shares in a business than if you're buying assets. And if you are buying shares, then you're taking over all the past liabilities, obligations, responsibilities, so on and so forth. Therefore, you've got to have really good warranties to give you peace of mind. Otherwise, you may be stung with some costs which you weren't aware of. And if you don't pick them up in the due diligence process and the warranty don't cover you for it, then you're going to have to pay up for it. I've seen that as well, where people have bought businesses, didn't do any due diligence, and then somehow they end up on my doorstep and say, I now have a £25,000 tax bill which I wasn't aware of, that I've got to pay. And this has happened, by the way, that's why I'm sharing this example. How do I get out of it? You can't. You should have checked. Did you do a financial DD? No, I didn't, because my accountant quoted me £7,000 to do that. And I thought I'd save that cost. Having saved it, it's now cost them £25,000. I mean, it's not funny, by the way, but I just think, you should have done this properly, because you're buying something which is of significant cost to you and value, and you didn't do all the checks and balances properly. I mean, why wouldn't you? That's one of the first thing you ought to do. So once you're going through the due diligence process, if the profit doesn't add up, by the way, that then gives you an opportunity to go back and say, look, our figures show the profit isn't £50,000, it's actually £35,000. So we agreed a multiple of 3 times EBITDA, 3 times 35,000, okay, gives us £105,000. That's what we're going to pay you, and not the 150 that you were originally asking for. Like I said, if you're smart, you'll turn the 150 into 120 by negotiating. But I'm just keeping the numbers really simple here for you to follow. If in the DD process everything adds up fine, you've made an agreement, you've got the mechanism there in terms of the EBITDA multiple, you're good to go. But quite often what you'll find is that doesn't add up. Something else which is important is sometimes sellers will tell you, I only want you to use last year's EBITDA. I would resist that and say, worst case scenario, you want to do, the last 3 years accounts, which means you check the last 3 years financial. Because what people do is when they look to sell, what you'll see is if you get last year's profit or the most current year's profit, it's, let's say, £50,000. Look at the year before, it's £40,000. Look at the year before, £30,000. And if you look at all the years before that, it was always around about £30,000. And you think, lo and behold, in the last couple of years, okay, you've increased your profit significantly. I wonder why that is. Because you were thinking about selling your business and you've increased and upped your profit somehow. Maybe there's some jiggery pokery and maybe there's some genuine reason. Either which way, your job is to try and suss that out and find out as much as you can. And you can only do that through due diligence, because sellers will tell you their word is their bond and they're the most honest person on earth, and they want to sell this business to you. They started it from scratch, or their father started it, or their grandfather or grandmother or whoever started, and they want to see this business continuing and flourishing forever. Yet they'll tell you all the stories that they think you ought to hear to get the money out of your pocket into their back pocket. So I'm not saying we shouldn't trust them. I'm saying take all the information that they give you on board, but you have to do your own checks and balances to make sure, because the law is very clear. It says buyer beware, and you need to make sure if the seller has 1 pair of eyes, you have 100 pair of eyes, checking through everything with a fine-tooth comb. Yes, that comes at a cost, but you've got to make sure you're buying what you think you're buying. Otherwise, there's trouble ahead. And in your heads of terms, what you can also agree, by the way, is if the seller pulls out, or if the numbers aren't what they are, and the amount changes, as in the mechanism doesn't change, the multiple doesn't change, i.e. 3 times EBITDA, but if the profit isn't what it is, and the number comes down, if the seller tries to pull out because of that, and you've justified the reasons for why the profit is lower than what it ought to be, okay, then if they pull out, then you want them to pay your legal and financial costs. Because I've seen this a few times, by the way, more than a few times, where someone goes through the process and they've spent £7,000-10,000 with their accountant, they've spent 8, 10, 15,000 pounds with their solicitor, and the EBITDA is, let's say, 25% lower than stated, and the seller says, well, I don't want to sell now because it's not worth me selling at that price. Well, the price has changed because the figures have changed, because the EBITDA was the wrong figure, you overstated it. But they'll say, I'm not interested now because that doesn't work for me. Well, I've just spent £15,000 with my solicitor and spent £10,000 with my accountant. That's £25,000, not including any of my time and costs. Okay, can I have that back, please? No, you can't. I'm off. See you later. So you want to make sure you protect that particular position and say, if you pull out because of any reason not linked with something in the accounts, then you have to pay all my costs. Because just because you figured out the EBITDA is overstated, and now that the seller gets less money, isn't reason enough for them to pull out. Because if it is, they wasted your money, so they should reimburse you. Now, not all sellers will agree to that, but you've got to be firm on that. And remember, sometimes people try and do a deal so badly, they end up doing a bad deal. So don't be desperate about it. There's plenty of deals out there. If one doesn't work, go for the next one, the next one, the next one. Once you know how to source them, you'll see there's no shortage of deals and no shortage of money. So go to the financial DD, you go to the legal DD, you do that well within the time you've said. You then raise the funds through whatever source that you said you're going to raise them, and then you work towards completion. Once you've done that, you now have a business. You now need to be thinking about how do you improve and increase, enhance the performance of that particular business to increase the margins and the cash flow, to pay off the deferred payment to the seller, and also to pay off any loans that you may have, which you use to fund the business. And then the rest, of course, is going to be the cash left in the bank for you after you've paid the tax. Now, there are different mechanisms, by the way, in terms of buying businesses. Deferred payments are one of them. There are many different ones, and if I covered all those here, it would take me a lot longer. So I'm just focusing on one particular one, which I've seen work reasonably well, works for a sizable amount of sellers, works for most buyers, and it helps you reach a happy medium where you don't use any of your own money. So let's say that you've done the first deal, £50,000 was the correct EBITDA, you've paid whatever you paid for it, and now you're saying, I like this sector, I like this business, this works well, it's creating some income for me. Then the next thing that you want to be thinking about is, how do I now scale up and buy another business like this, and another, and you start scaling up, and before you know it, and let's say each of these businesses has some kind of a fixed place, so, and then you think, all right, I'm based in, let's say, Peterborough, because that's where I'm based. I am going to buy these type of businesses within a certain radius, and let's call it, you're saying, I'm happy to travel an hour, and let's say an hour means 60 to 80 miles. It might not be 80 miles, by the way, it might be 60, but let's just say 60 to 80 miles is a distance you're happy to travel. So you kind of create a hub and spoke around Peterborough by using a compass and seeing how far out you're willing to go, and then target businesses in those particular areas. So for me in Peterborough, you look at Cambridgeshire, Lincolnshire, Northamptonshire, Bedfordshire, Leicestershire, so on and so forth, all the kind of counties surrounding Peterborough. Once you've done that, then as you're setting up more and more operations, and your EBITDA is getting bigger and bigger and bigger, then the benefit you have is you create more cash flow. You're not depending on one type of source of income. You are now generating, let's say you've got 20 of these operations, all at £50,000 each. So these aren't big businesses, but what you'll find is once you've got 4 or 5 or 6, then you'll start targeting bigger ones, i.e. not 50 grand EBITDA, 150, 200 grand plus EBITDA. But let's just stick with 50 for now. So it's 50, you bought 10 of them, you've got £500,000. You can now start to fund all future purchases yourself. That's a nice place to be. And let's say you buy another 10 from the EBITDA from the first 10 that you're generating. So you get to 20, your EBITDA is £1 million. By the way, that's the route that I've shared with you is heavy lifting. You don't really want to buy 20 businesses to get to £1 million EBITDA. Because A, you want to improve the profits of all the ones that you buy. And B, after you bought 2 or 3, You want to buy bigger ones which have 100, 150 grand EBITDA, so you get to that £1 million quicker. Why £1 million? Because once you get to £1 million, then it starts getting interesting, because venture capital and private equity firms will be interested in funding your business. Other investors will be more interested in funding your investors. Family offices will be interested in investing in your particular type of business, which means they can give you money for a share of your business to scale it up even further. So from $1 million, you get to take it to $2 million, to take it to 3 million. Okay, so you have a big, sizable business. And the point of all of that is, as the business gets more sophisticated and it gets bigger, and you've got more operations and offices and sites, and the EBITDA increases, the multiple increases. So remember, you bought the businesses for 3 times EBITDA. Let's say you've got 20 of them now, all at 50 grand, and you've not been able to improve their profits, which is unlikely, because you're really good and you will do, and you'll find ways of doing that. And there are lots of people out there who can help you do that. But let's just stick with the 50 grand. You've got £1 million EBITDA, and you've taken no private equity or VC money or family offices money. If you sell that, the value of that is not 3 times EBITDA. It's changed now to, let's say, 10 times EBITDA. So 10 times $1 million is £10 million. So you now have £10 million potentially that you can sell your business for. You paid £50,000 for each business, and you've got 20 of them. So you paid £1 million collectively to buy those businesses over a certain number of years, and you're selling it for 10 times EBITDA at £10 million. I can say to you quite comfortably, for most people in this country, you're not going to earn £10,000 by working for somebody else. That's just reality. Look at the stats, look at the average income. Even if you're earning £50,000 or £100,000 per year, okay, if you're earning 100 grand a year, in 10 years, you would earn $1 million. In 20 years, 2 million. In 30 years, 3 million. Let's say you work 40 years in your life. If you do, you'd be on 4 million. 10 million is still a long way away on an average income of 100,000 over those 40 years. So you can see how lucrative and exciting this is. Now, of course, there's a lot of blood, sweat, toil, tears in that particular process, and you've got a lot of hard work to do. And of course, most importantly, you are going to improve and increase that £50,000 EBITDA per average office setting business. And if you increase it by, say, 50%, and it becomes £75,000 EBITDA per setting times, or per business, times 20, or business of operation, gives you 1.5 million EBITDA. Times that by 10%, although the multiple might be slightly higher, but if it's 10%, now you're on 15 million. Big difference between 10 million and 15 million. Incentive enough, I trust and hope, to have your focus and attention to help you to set that up, to scale it up. And this isn't easy, by the way, but nothing ever is easy. It is simple. And most people don't grasp this concept in terms of how it works, how to do it. They find it daunting, but I can tell you it's an exciting journey. I've been on it with quite a few different clients, and it's always been interesting. Things don't always work out as we thought, because nothing ever works as per the business plan, but it does work. There is potential. It's going to help you grow personally. You need to have a growth mindset. The end result, in terms of what you create and what you can actually generate, is exceptional. And the final result, which is exit should always be at the forefront of your business plan when you do this, in my view, is you're going to have a huge multiple, with all things being equal. Okay, when you exit that particular business, which means you get a nice payout. It's a huge, significant pension, which will help you create wealth for yourself, your children, your grandchildren, and the next few generations. Because when you've made that money, you can then invest it in sensible, smart ways to help you create even more intergenerational wealth. And you can see from the example I've shared with you, and I've not just tried to make it very simple for you, but I have simplified it. This can be done by anybody, anywhere. I've seen people with no experience of a particular sector go into a sector, scale up. I've seen people who've got lots of experience in a particular sector go in the same sector and messing up because they just weren't enthusiastic about the business. So it's not guaranteed to work just because you know more about it. In fact, usually it's less likely to work if you know more about it, because you might not be as enthusiastic. If you are enthusiastic about it, then obviously you'll make it work. And I think enthusiasm is the important word here. But don't think just because you don't know much about a particular business that you can't make it work. You'll learn very, very quickly, especially when you've taken on responsibilities in terms of paying people off, in terms of debt, and having a deferred payment. But it does work. It can work. You can make it work. It's a fantastic second, third, additional source of income, and the journeys are phenomenal, and the end result, of course, the EBITDA multiple is great too.
Thanks for listening to Wealth Made Simple. You can follow and contact Shaz on the Facebook pages Entrust Property Tax and The Profits Wizard. You can also find Shaz on LinkedIn, YouTube and Instagram. Alternatively, email him at shaz@aa-accountants.co.uk. Build your wealth by mastering money.